Welcome, guys, to the 2020 election impact. And we're going to talk about actions you can take now. We are in the beginning of December of 2020. I'm so ready for this year to be over. And I've got Chris Mann here, good friend of mine, CPA, head of Mann CPAs, headquartered out of Roseville, California. And any initial thoughts before we get started, Chris? Anything that you're hearing from clients? By the way, this is as much of a Q&A as it is a sort of a conversation that Chris and I are going to have. There is a Q&A button. If you would like to ask a question, go ahead and punch that into the Q&A. You can write your questions in there. We will try and answer these as they are asked. But any thoughts on 2020 and the tax year that 2020 has been, Chris?
Well, I think there's a lot of different things that have gone on this year with the stimulus, with all the government loan programs that we've having to navigate through, and a lot of misinformation out there. A lot of people thinking that these are technically they're non-taxable events, these PPP loans, but they're really not, because you don't get to write off the expenses that are associated when you use the money. So technically they are taxable. So it created a lot of confusion there. Also, there's maybe a second round of PPP and second round of stimulus coming around that may happen or may not happen. They're shooting for the 11th of December. Also, maybe tax increases for 2021. We still don't know really who's running the Senate yet. We won't know until really sometime after January 5th. So I think those are all a lot of unknowns that are still hanging out there. But generally I've found that we've had some businesses are just rolling along like nothing's happened. We've had others that have hit some bumps, but they're still moving along. And then we've had others that have been decimated by this whole thing because they've been shut down by the government.
All right. So here's what you guys need to know. I'm a lawyer. I'm talking. This is not legal advice. And Chris is a CPA. And this is not tax advice. So this is information only. Don't take what we say and run off and start doing a bunch of stuff. So here's what we're going to talk about today. We are going to talk about Prop 19. That was a really big deal that was passed. It basically takes your Prop 13 tax base away from your kids, because right now, at least until February 16th of 2021, parents can leave their home of any value to their children, and their children inherit their Prop 13 taxes. All other real property, the parents can leave up to $1 million in assessed value each to each child. And that is going away, right? That second part is just eliminated February 16th. So we're talking to a lot of people coming in saying, hey, how can I preserve Prop 13 for my kids? There is a structure for it. We will talk about that. You want to talk about Revenue Ruling 2020-27, Chris?
Sure. That's the one where you basically, you get the PPP funds, you use them for payroll, use them for pensions or self-insurance, things like that we were supposed to use them for. The problem is we can't write those things off. And so effectively, when you look at somebody's profit and loss statement, you have to take those things off of that and add that back into their profit. And so it's hitting people pretty good, because it's obviously an extra income or reduction in expenses that they get to write off. What I was hoping that the government would do, and they still may do it, but I don't know. We'll see. It seems like it would be an easy thing to do, was to just take this PPP provision, this Revenue Ruling 2020-27, and just say, look, we don't have to, we're going to let you write off those expenses. And it basically would give everybody probably between a 20 and a 40% bump in what they're doing, because then they get to keep all the PPP money instead of just the portion net of tax. And so it would be another stimulus that the government could do without really doing much. But I don't think they're going to do it. I haven't heard anything, but it seems like it would be an easy one for them to do. But it definitely is something to look at. And we're doing a lot of that right now with our clients, is the planning to make sure people are not surprised come April, because no one wants that. And so at least if you know that you got this coming, you can put the money aside right now and it's due in April, and have it available and make sure it's part of your cash flow planning.
Well, there was another Prop 19 years ago. So if you're doing any Googling on this and researching it on your own, you will find that the other Prop 19 legalized marijuana in California. We're not going to talk about that one, but it's interesting. You said that there's no tax deduction for expenses used for people who use the PPP loan for those expenses. It kind of makes everyone like a cannabis dispensary, right? You can't deduct those expenses. So maybe, I don't know. That I was trying to
Very
think.
similar. It's
All
very
right.
similar when you look at it. It's like the IRS, really, Congress came out and said this was supposed to be a tax-free deal, and it is. So you don't have to put it in your gross income at all. But what the IRS has come back and interpreted and said, look, you can't double dip. We're not going to let you have this money as tax-free, and we're going to allow you to write off the expenses that you use it for. So the IRS is saying no to that. We're hoping that maybe Congress will come around and figure something out on that. I don't think it's a high probability of it. That's why our advice to our clients is just make sure you have some money available, that this is going to happen, and you're going to have to you're not going to be able to write off these expenses, and therefore you're going to probably have a tax bill potentially in April. I think there's going to be two types of tax bills this year that'll be surprising to people. People that don't do planning right now, and they thought the PPP funds were tax-free, which they are, but they didn't realize they can't write off the expenses. Now they're going to get hit with an unexpected tax bill in April. I think the other group is people that have been on unemployment all year, because a lot of people don't realize unemployment is taxable to the feds, not to the state. But a lot of times people that expect refunds back every year in the spring, they may not get them this year, or may not be as big, because unemployment is now taxable, and a lot of people don't have taxes withheld from those weekly checks.
We're going to talk about Biden's, I call it his Christmas list of tax changes, his wish list, primarily loss of 1031 exchange. That is a big deal for real estate investors. And last call on income tax reduction strategies for 2020, meaning there are some strategies you have to do before the end of the year. A lot of these, the effective date is December 15th, which is not, it's just a week and a half or so from now, a couple of weeks. We're going to kind of recap the 40 tax. I'm going to give you a list of 40 tax planning strategies and highlight the important ones, and then stuff you have to do before 2020. You can't, some of these strategies, Chris, is, that we've talked about, you have to do this year. You can't wait until next year. So let's get started with Prop 19. So Prop 19 is, it affects Prop 13 for your kids. It's very important. This enhances Prop 13 for the individual homeowner. And this does not affect, at least yet, this has a net positive. So if we're talking about you and your home, there's a lot of positive in here. When it comes to leaving your property to your children, that's when it gets reassessed. And there's going to be no more parent to child reassessment exclusion. So to understand Prop 19, you have to understand Prop 13 and Prop 58. I know it's a lot of numbers to throw at you. First, Prop 15 did not pass. Prop 15 was the one that would have reassessed all commercial and industrial properties with limited exception. That didn't pass, but it did get 49% of the votes. So I could see this on the ballot in future years. So it's something you want to pay attention to. If you're picking up your 199A deduction as a real estate investor, and you have gross leases, meaning you charge a tenant, $2 a square foot, and you pay all the expenses, you can pick up a 199A deduction. If you pass through the expenses, not so much. You may want to reevaluate that on your leases coming up. If you have commercial and industrial leases, you may want to look at passing that tax bill to your tenant. Prop 19 did pass. Up. But so Prop 13, let's go back to 1978. Prop 13 was passed. This is actually me and my parents here. My parents bought a condo, and this is what Prop 13 is. My parents bought a condo in the 70s for $30,000. They moved out the next year. The thing's worth $435,000. The taxes are just slightly over $800 a year. That's Prop 13. Under current law, I inherit my parents' Prop 13 because Prop 58 was passed in the 80s. So this little chubby kid here, that's me, sweet, I get to keep the Prop 13 taxes. This structure is going away February 16th. There is something that you can do before February 16th, and you better get on it, because a lot of people have been reaching out to us saying, hey, Jim, I heard you say there was something you could do before February 16th. There is, but you need to get on it. We had one question from George. George says, all of our rental properties are owned by their family trust. This is a living trust. My wife and I are the current trustees. We're going to add our adult children as trustees this year. Our concern is that there'll be a property tax increase or reassessment because we added the kids. George, adding somebody as trustee does not cause a reassessment. the Board of Equalization and assessor, they look through the trust to look at who the owners are. So if this is a typical living trust where you and your wife are the owners of the property, where you're the beneficiaries, just because you change trustee, that's not a change in ownership. It's only when you pass away is there a change in ownership. And I did see, George, that you listed that you have 10 properties. You probably want to, and if Prop 13 is an issue, you want to go to our website, you want to book an appointment, and there's a way you can do that on our website. It's a 1-hour appointment. We're charging $500. You will know we need your property tax bill, your estate plan, and a questionnaire that that shares your information about you with us. After an hour, you will know if you need to do something or not. Okay, so a lot of people have been taking us up on that offer. So Prop 13 is great, but what happens if mom and dad sell the condo to somebody else? What happens? Well, they sell the condo to this family. The property is reassessed at its fair market value of $435,000. The taxes jump from $800 to $5,000. Okay, so the taxes jump when there's a change in ownership. In California, Prop 13 is the property is reassessed when there's a change in ownership, when it's sold, when somebody passes away. Death is a change in ownership, and it's reassessed at fair market value. But as you know, if you have own real estate in California, your property taxes can only go up according to the California Consumer Price Index, not market value, and that's capped at 2%. That 2% cap keeps your property taxes low, even though your property increases at maybe over 4% a year. And it is not uncommon for clients to have a $500,000 assessment on a $15 million property. Okay, maybe something they bought in the 70s and they want to pass that assessment to their kids. They don't want the property taxes going up to $170,000 from 6,500, right? Because that, for some of our clients, that's a huge increase in taxes, and so people, they just don't want to pay more in tax. So this 834 versus 5,000, that's the little kid in front of the condo. That is Prop 13. Something you need to know, effective February 16th. This whole structure goes away. When property passes from parent to child, it will be reassessed. Okay. You can also leave as a parent until February 16th. You can leave up to $1 million in assessed value of property per person. So this is a very valuable property right that people have. But again, it's going away February 16th. And this repeals Prop 58, the parent to child reassessment exclusion. So there is some good stuff in Prop 13. And unfortunately, I made this really dark, so it's hard to see. Prop 19 allows you to take your Prop 13 taxes with you anywhere in the state of California, 3 times in your life, right? This is April 1st and later going forward, even if it's more expensive. If the property is more expensive, you have to be over 55 as well. If the property is more expensive, then the difference between the values is added to your tax base. And that's a real departure from current law, because current law says, as you know, Chris, if you move and you take your tax base, you can move inside the county and about to maybe 7 or 8 other counties across California. You can take your tax base with you, but if you buy a property of greater value, you get fully reassessed on the entire property. So Prop 19, super powerful property right. So let's look at this example. A husband and wife buy a property in Pasadena in 1980 for $200,000. What happened to real estate from 1980 till now? It's gone up, right? It's now worth $1.2 million. Property tax bill is about $5,000 a year. The husband and wife sell their Pasadena home. They move to Northern California, to Roseville, to be closer to their kids. They downsize to $700,000. They keep their Prop 13 tax base. The taxes stay the same. What if they decide to move down to Carlsbad? So same house, they paid $200,000 for it. It's worth $1.2 million. They move to Carlsbad. They buy a $3.2 million property. The first $1.2 million, they keep their property tax base, and the extra $2 million is added to their tax base. So their property taxes become $30,000 a year instead of $40,000 without Prop 13. So this is a very valuable property right, guys. And I can't tell you how many people are calling me, and these are typically wealthier people, but they say, I have a beach home in San Diego. It's waterfront. It's an $8 million property. I want to buy a $9 million property in Malibu waterfront. Okay, this is a real case. Now you can take your Prop 13 tax base on your $8 million property and only add about $12,000 a year to your tax bill instead of having, you know, $100,000 tax bill.
Hmm.
So this is all good until February 15th. Something you need to know: February 15th is a court holiday. The recorder's office is closed. It's a Monday. Recorder's office is closed on the weekend, and February 12th is also a holiday. So February 11th is our real deadline date. So mom and dad buy this home, and here's Prop 13 until February 15 of 2021. Mom and dad buy this home in the desert for $100,000 in 1990. It's now worth $700,000. Assessed value is $200,000. The child inherits the property. The child inherits the parent's property tax base at $2,000. The property taxes don't go up. Something to be very mindful of with Prop 13, it's not just the taxes, the low taxes that you pay, but the increase every year, it only goes up 2%. So these taxes are only going up $50 a year. But after Prop 19, after February 15 of 2021, this home, where the parents are paying $2,500 in property tax, it jumps to $8,700 a year, and they increase, you know, more importantly, they increase $175 a year. And you say, well, that's not that much money, but this has this snowballing effect. And so over time, it can mean real money. So we have, we're about 98% done with a solution. We call it a Prop 13 trust. There are a few variants of it. It allows you to transfer your property base to your children now to preserve that Prop 13 for your children for their lifetimes. But you got to do this before February 16th. You're the grantor, your children are the beneficiaries, and the change in ownership occurs. Whether you should get an adjusted cost basis or not at death is case specific. There's no one size fits all. And each plan is really highly dependent on a broader set of facts. So on a high level, the clock is ticking. If you want to keep Prop 13 for your family, and this is not just a vacation home or your residence, but it's also rental properties, commercial, industrial, whatever it is. Very important. If you want to preserve this, you do have to act now, and you really need to get on it. Our capacity is kind of stretched, and we're just in early December. So seek advice right away. Don't wait till February 16th. You can go to our website and set up a time to meet. We do need your tax bill, your current estate plan, and your personal and financial information. And I probably should have looked at this slide deck before, but it's been a busy day. The fee is $500, not the E is $500. So you want to talk about Revenue Ruling 2020-27? I think we talked about it.
Yeah, well, you know, one of the things I wanted to add about that, Jim, is that you know, we were thinking about, you know, with this PPP loan, you know, most people haven't gotten it forgiven yet. You know, it's been, you know, some people are waiting around to see what the government does, and so and the banks have been slow to get things going in that area. So one of the things we kind of thought about during this planning process is, do we have the flexibility to show this technically as income in 2020, or can we move it to 2021 when it's officially forgiven? And we thought, wow, that's a pretty good tool maybe to decide what's the better year to take this hit, you know, whether it's 2020 or 2021. Well, the IRS just came out with this deal saying basically if you reasonably expected this deal to be forgiven, then you have to deal with it in 2020. So we don't have that capability to make that decision. We might in a few cases where there is some question of whether it's going to be forgiven or not, but for most people, I think you're going to find that most people are going to have this forgiven, and they could reasonably expect it to be forgiven. So you're not going to be able to use that strategy as we had hoped.
Yeah, you know, it's not taxable, but it is taxable. It's kind of a roundabout lawyerly way of, I mean, the bottom line is it is taxable. John asked a question for Prop 19. This is the solution to add the kids as co-owners of the property. You need to look at Revenue and Taxation Code Section 60, and I'm concerned that may not meet, and here's this is very important, that may not meet the requirements under Revenue and Taxation Code, or it may only partially meet them. And this, what's really frustrating about this, Prop 19 amended the state constitution. The legislature is convening in January to pass what is called enabling legislation that amends all the statutes to conform to the California Constitution. We won't know what the rules are until it's too late. We could find out what the rules are in May or April. after the February 16th deadline. So very frustrating as a lawyer. And I know, Chris, this happens a lot with, laws are passed, and we'll talk about that with Biden. We can get a law passed in November of next year that's retroactive to January. So, if you think, well, those laws are only effective, they're not retroactive, many times they are retroactive. And so it makes planning a little bit different. But let's talk about Biden's Christmas list. Chris, I know he basically wants to raise taxes on, well, I don't know if this is individuals or married couples, hasn't been really specific. If you make $400,000 a year or more, tax rates are going up. Capital gains tax rates. You want to talk about payroll taxes, what his proposal is?
Yeah, I mean, the one thing you got to think about with all these things is that you've got to think about really what's going on in the state of Georgia, really. I mean, because if these Senate runoffs that are happening on January 5th, which obviously is after the new year, so we don't know what's going to happen, but as long as one of those runoffs for Senate stays Republican, chances of a lot of this stuff happening soon are going to be slim, because I don't think the Senate's going to allow a lot of this stuff, and they have to play ball with the Senate. So there's not going to be, if for some reason they lose both of those races and the Democrats take control of the Senate, then I think you could see a lot of this stuff get done very quickly, because they know they have a 2-year window to get a lot of things done where they have full control of both houses in Congress and the White House. So therefore, they're going to try to get stuff as fast as possible. If you think back when Trump won in 2016, he didn't get his tax bill done, and he had full control of the Senate and the House until 2018. So it takes a while to get this stuff done. So chances of something happening in 2021 with any of this stuff, in my opinion, is slim. Although if the Democrats take control of the Senate, I think it could be, you could see some of the stuff happening. Like you say, it could happen in November of 2021, and they retro it back to earlier, the beginning of the year in 2021. And so getting back to the payroll taxes, what they want to do is basically say to anybody that makes more than 400,000 in wages has got to start paying Social Security tax again. Is that really what's going on? And that's a big deal, because it's 6.2%, and the employer's got to pay 6.2% on their side. So that's a huge increase if that goes through. So you have right now about the first 140,000 in wages, you have to pay Social Security tax and Medicare tax. The employee pays half, the employer pays the other half. What they want to do is between that number and 400, you would only pay the Medicare portion. After 400, you go back to paying both again. That's what he's proposing to shore up Social Security and just bring in more revenue into the system.
So just from a budget forecasting, I mean, frankly, I could see this happening. This is one of the proposals that I could see happening. There are ways to game the system and bypass it. But if I have a company and I've got some highly compensated people, some salespeople, whatever it is, should I be putting this into my budget? Or is it just kind of a rounding error?
Well, I would wait to see what happens in Georgia, because I think if the Republicans win at least one of those seats, which they probably will, it'd be very surprising, in my opinion, that they lose both down there. But you never know. Things could, who knows what happens when you're dealing with this stuff. But if they retain control of the Senate, I don't think that's going to happen in 2021. I wouldn't put it in my budget. But if they do, I would start to think about it.
Okay. Also, I mean, all these other taxes too. I mean, if they do get control of the Senate, although they do have the filibuster still in the Senate, but they're talking about, that's the nuclear option. Capital gains taxes. This is kind of an interesting one. We do see clients sometimes have a capital gain that's pretty significant. If you sell a piece of property you've had for a long time, if you're trying to do a 1031 and that kind of falls apart, this is assuming there is a 1031 around. But capital gains tax rate, 39.6% for gains over $1 million. That's a real big number.
Because right now it's 20.
Yeah, and a lot of our clients have debt on the property. So remember, if you have a $1 million gain and you're levered on the property, if you have a property that you're going to realize $1 million gain on, but you only get $100,000 from the proceeds, you're kind of upside down in the property. You're going to owe taxes and you're not going to have the money to pay. So that's
Right.
something to pay attention to.
Well, and yeah, the other one you have on your list to repeal is Section 199A.
Yeah.
That's a huge deduction for a lot of people. What that basically is, for most people, there is some businesses that are excluded from this, like mine and yours, for the most part. Um, you get to take 20% off the top as not, and don't tax it. So let's say you're a business owner in the manufacturing of something, and you make $1 million profit. You get to take 200,000 off the top and not have it subject to federal taxation. At 37%, you figure times 200,000, that's like 75 grand right there you're saving in tax. But that could go away under Biden's plan. But again, these are things that I just don't think are going to happen right away unless the Senate falls back to the Democrats, because I don't think that the Senate's going to play ball with any of this stuff.
How important is this 199A deduction for your clients? I mean, and it's kind of tied. I see 199A as tied to the SALT limitations, the state and local income tax or state and local tax limitations. If 199 is repealed, do you see the SALT limitation being repealed as well, or would they just leave it in there? I mean,
yeah, they want to get rid of it because they promised people in California and New York that they would get rid of it. But really, in my opinion, that's kind of hollow, because a lot of people think they're getting deductions for state and local income tax and property taxes. But the problem is alternative minimum tax comes in and rears its ugly head. And it basically, you lose out on those deductions anyway. So a lot of people that think they were getting those deductions are not getting them in the SALT deal, meaning the limitation where you can only take your state and local income tax and your property tax on your house and limit it to 10 grand as a deduction, as an itemized deduction. That hasn't really hurt people as much as you think, because they weren't getting a lot of that anyway. Because I'll admit, I'd rather have the 199A any day.
So how likely do you think this is that Biden's is going to get, let's assuming that, because we're talking about his Christmas list. I mean, how likely is this?
I don't think it's very likely, even if he got the Senate, because the real estate lobby is pretty strong, number one. And number two, you got to think about it. When Trump won in 2016, he had a lot of different things he wanted to put in place for taxes changes. He didn't get all of them done, even though he had the House and the Senate. He didn't get a lot of the things he got the signature stuff that he wanted done, like the top corporate tax rate dropping from 35 to 21%. That was one of his bigger deals. But he didn't get a lot of other things like similar to this type of stuff done. So I think the real estate community is pretty strong out there, and they would be fighting this one and calling their representatives in the lobby would be in Washington doing a lot of things to make sure that doesn't happen, because that would be really hurtful, I think, to the real estate community to take this out.
Yeah. And it doesn't hurt the big players like the real estate investment trusts, because they typically don't, like the really rich people are my super wealthy clients. A lot of them, they'll do a 1031 exchange, but a lot of times they won't, because they've got other stuff going on and they just don't need to. So I think this is really going to hurt the people who are trying to build wealth for their families, and just kind of lock them into holding onto a piece of property. By the way, the California Association of Realtors was the #1 donor to Prop 19. And what you're going to see starting April 1st of 2021, where you can use Prop 19, a lot of people are going to be moving their primary residence and taking that tax base with them anywhere in the state of California. So that's a very important, powerful property right. So we have some tax planning strategies for 2020. I just want to remind everyone, Roth IRA conversions, that's something you should check in with Chris on. If you're going to do a Roth conversion for 2020, you have to do it in 2020. Correct, Chris? You got to do it.
Yeah.
And so, if this is all about tax bracket management, if you kind of feel in your heart of hearts that you're going to make more money next year, or your tax bracket's going to be higher next year because of a law change, you may want to consider a Roth conversion. There are two benefits to a Roth conversion. One is you are taking money from a taxable account and putting it into a non-taxable account. And secondly, there are no minimum distributions from a Roth while you're alive. Now, when your kids inherit it or whoever inherits it, there is a minimum distribution 10 years after you pass away, but there's no minimum distribution while you're alive. And I would say capital gains harvesting. You know, a lot of people are worried about an increased capital gains tax rate under a Biden administration. And so some people are choosing to harvest those capital gains and essentially pay the tax at a lower rate. And then also the solar investments, the solar investment has become more attractive in 2020 because of the CARES Act and accelerated depreciation. And I was on a call this morning with a client looking at a solar program. Basically, you put $1 into the machine and you get, in this client's case, $1.50 less in taxes owed. So you know, if you have a tax liability of $200,000 or $300,000, you put $200,000 into the solar investment and you pay $300,000 less in taxes. So that's a good way to reduce for many people, not everyone, but it's a good way for many people to reduce their tax liability.
Hey,
So,
Jim, on the
yeah.
Roth thing, just real quick,
Yeah.
because this is real pertinent because like you said, you got to convert by the end of the month. You can't go into next year with it if you want to get it for 2020.
Right.
I had 2 cases yesterday, live cases, one of them where they have large losses and it was so easy to move it over because it's going to be free. You know, you basically move
Right.
it over and you don't have to pay a nickel of tax on it at all, and it's going to be moving forward. So it's perfect. The other one, it was going to cost a bunch of money to do because they're already paying tax. And so the real deal there is if you don't have money to pay the taxes from other funds, you probably can't do it. And once we worked through that whole process, it was determined by this person, I can't do it because I don't have the money set aside anywhere to pay the taxes that would be due on this. And so that's real important when you're looking at converting to a Roth, is whether you have the funds to pay the tax, or if you're in a situation where you have a loss or something like that, where you don't going to have any tax, and you can offset that. That's the best way to do it, is to do it for, you know, almost where there's no tax.
So if I have a rental and not many of my clients have tenants not paying, how are you treating that? Are you treating that as an account receivable on the financial statement, or how are you treating unpaid rent for people?
Yeah,
Who don't?
you just, for them, they treat it as they're trying to collect it. But when we file their taxes, we're just going to show the rental schedule with no rental income or very little till this thing hit, and then all the expenses you still have. You know, in a lot of cases, some people have deferred their payment, so they may not have as much interest as they did in the past.
Mm-hmm.
But for the most part, it's just going to be a loss. Rentals are tricky though, because everybody has different situations. Because for some people, they have the big loss, but they can't take it because it's passive.
Right.
And so therefore it just sits out there and we eventually get it, but it may not be this year.
Anonymous asks, are Prop 13 trusts irrevocable? Yes. What are the downsides of this type of trust? Okay, so the downside to a Prop 13 trust is a descriptor, like you would say a living trust. Okay, but it's not a living trust because it's irrevocable. But it's a lot of different. There are variants of it. But the primary downside, if you're going to put your primary residence into a Prop 13 trust, the downside is you miss out on all the good stuff that's in Prop 19, where you can transfer your tax base. If you're in your forever house, or you're not going to sell it, and if your kids aren't going to sell it, and that's the real issue. If you want to pass this property onto your kids, you need to look at this type of planning. But if you say, my kids don't want any of my property, when I'm gone, they're just going to sell it all and divide up the money, then you don't need to do anything. But the chief downside, if you put a home in your residence into this Prop 13 trust, you lose the ability to transfer your tax base to another property. So we met with a client whose wife recently passed away, and the husband is now the surviving spouse. And the husband had a multifamily that he inherited in Los Angeles with a very low tax base. So he's 87. He inherited this low tax base. It's a $5, $6, $7 million property, and his property taxes are $3,500 a year. So what he's doing is he's transferring that property to his kids now. So he got an adjusted cost basis at death, and he's able to transfer the property now, and the kids keep the low Prop 13 taxes. And so they'll pay $3,500 a year in tax instead of paying on a $7 million property, $100,000 a year. I mean, the numbers that's almost $100,000 a year difference. The numbers are huge. Okay. Or they can be huge. So that is a benefit of, in that case, it made sense to make a transfer of the property. So I will just open it up if you guys have questions. If you would like to speak with Chris, you can give him a call at 916-774-4208 and schedule a 15-minute call for help. For us, you can set up a Prop 13 meeting. You go to our website and sign up. And Chris, I don't know if it sounds like you're not charging for that call, but we are so busy with Prop 13 now with people. We're charging because there really is value, quite frankly, is after this 1 hour meeting, you'll know, do I need to do anything or not? And really the clock's ticking on this.
No, we don't charge for the call. We're just happy to just help out with some things. If we get into something more, much more complicated or much further along, then obviously we can figure that out later. But we're fine doing the call with anybody that has any issues.
So the question is, can you repeat the answer for Prop 19? The solution is to add the kids as co-owners of the properties. That was a question. So here's the problem. Adding people as co-owners of the property, I don't think solves the problem. At best, if you add someone to the property, first of all, that may not even constitute a change in ownership if you add somebody as a co-tenant on the property first. Secondly, even if it does constitute a change in ownership, you still own part of the property, so your portion is going to get reassessed. That is not what we would consider a safe, solid strategy. You do need to effectuate a change in ownership. A trust structure is better because there's a lot of stuff you can do in a trust to get, for example, an adjusted cost basis when the grantor, the parent who transfers the property to the child. If you retain enough strings on the property, it comes back into your estate, so you get an adjusted cost basis at your death, but it's still a completed transfer for property tax purposes. And like I said, we're about 98% done with that strategy. There is a way. I've been working with a very small group of frankly brilliant lawyers all across the state, and we've leveraged the Zoom platform, right, to meet and share our knowledge. And it's actually a really exciting time to be a lawyer. I will say though, on a personal note, it has required a rewiring of my brain because you have to unlearn what you've learned and relearn a whole bunch of new stuff, because it's a lot of doing the opposite of what you used to do. So that's just kind of part and parcel of being a lawyer. They've kind of turned a lot of stuff upside down. So, I don't know if Prop 13 is a big issue for your clients, Chris. Is it when they leave property to their kids? Do they want to keep the low property taxes or not?
Oh yeah, everybody would want to do that if they can. It's definitely would be a big issue. For our clients, and a lot of our clients have the rental properties too.
Yeah. Yeah, and a lot of our clients have rent control. If you've got a property in a lot of Bay Area areas, Oakland, Berkeley, San Francisco, Santa Monica, Los Angeles, a lot of those places have rent control. And imagine if you're just kind of barely making it because you're under rent control, and then your taxes go up 10-fold or 15-fold. It's crazy.
Yeah.
And then
and
then if they eliminate the 1031, you're stuck. Right?
Yeah.
What are you going to do?
But not only that is the other one that Biden wants to put out there. And I'm not sure to get this one either, because the real estate community will fight them tooth and nail on it, is that not getting the step up in basis on assets upon death.
Oh,
that's a big one, because when you pass away, you give your stuff to your kids, they get to reassess the value of everything. And now you basically avoid a lot of capital gains tax upon disposition of a lot of that stuff. Well, they want to get rid of that, which would make everything be subject to large capital gains, perhaps, for, let's say, property you own in those scenarios you showed earlier, where you bought the property, 20, 30, 40 years ago, and now it's worth way more. So you wouldn't get to be able to take that step up in basis to close that gap.
So what about buying a car before the end of the year?
Yeah, it's always good. Whenever I talk to clients about stuff like that, or anything that has to do with spending money, I always preface it with, if I told you there's no tax benefit for it, would you still do it? Because to me, it's like, when you're dealing with stuff with your business, it always should be, is it going to help the business? Or in a car situation, it's more lifestyle and what's best for you and all that stuff. So I always try to remind people, because we get so, and I'm guilty as anyone else, we get thinking about the taxes so much that we lose the deal that we should be running our businesses real well, and making sure we're not just wasting money. Because when you spend money, you're spending 100%. Whereas if, the taxes only cost you 45 or 50%. So to me, it has to be something that has value to the business, or it's going to make your life easier, if it's going to, improve sales, or you think it's going to. And in the case of a car, it's going to be kind of more of a lifestyle situation. Do you need one? Do you want one? That type of thing. We'll make the tax situation work in all those scenarios, but it has to be really make sense business wise.
Any other tax strategies that are any quirky things that people need to, and we'll kind of wrap it up here. If anyone has any questions, go ahead and put it in the Q&A, but any quirky tax stuff we need to be paying attention to that we didn't talk about?
Well, I think that, to me, I would operate everything based on the fact that taxes are probably going to stay the same in 2021, thinking that if you're a betting person, that the Republicans will probably retain the Senate, which will help keep things at bay. I think divided government is the best of all worlds because it keeps everybody in check with some things, and so it'll slow things down anyway. So I think we should be good for 2021. A lot of people have asked me, should I accelerate income into 2020 or things like that? I don't really think you have to do that, unless there's a special circumstance there. But at this point in time, it's really down to just figuring out where you are with your 401k. If you put the max in, can you put the max in? Do you want to put the max in? Roth conversions, potentially, does that work for you going forward? I mean, at the end of the day, we all know at some point taxes are going to go up.
Yeah.
I mean, they may not go up next year, but you got to figure down the road, that's the general direction they're going to go up. All this money they've been spending on COVID they're going to have to recover some of that at some point, but it may not be next year.
Here is something I've noticed is this K-shaped recovery. They talked about rich people getting richer and poor people getting poorer. That's happening. And there's also a shift in I think there's a shift coming where taxation will be used not only as a fiscal policy, as a way of raising money, but taxation will be used as monetary policy to keep inflation down. And what that means is as the economy gets going, be prepared for higher taxes. If you're a high income earner or you have a lot of assets, be prepared for the taxes. And the idea is the government takes that money out of circulation and keeps the economy from overheating and inflation from overheating. So Nicole asks, Prop 13 trust, what if you create a trust and then the older parent needs to sell it later in order to pay for assisted living costs? Nicole, we're setting these trusts up as grantor trusts, which means the parent keeps their 121 exemption, their Internal Revenue Code Section 121 exemption, which is a $250,000 or $500 $250,000 or $500,000 exemption on part of the gain. Craig asks, could I get caught by crossing a tax year? Example, my parents passed, leaving their 50-year-old home. No kids will take it, will sell it. Will I have time to sell it without incurring a change in ownership? Craig, the change in ownership occurred when your parents died. So under the California state law, the change in ownership has already occurred. There will be a supplemental assessment. So that's something I would encourage you to check in with us and on essentially a trust administration, which is helping people after someone's passed away. So Anonymous asked, these are my questions, a whole bunch of questions. Mr. Cunningham said in his video, I'm assuming that you're talking about the video that's on YouTube, that he was trying to find out whether the parents could keep the rents and use a general power of appointment. You can't, general power of appointment is problematic for property taxes. There's a workaround, but you have to be very careful. We're working on the workaround. You must be very careful. What if you change your mind or want to take away the gift? That is an issue. So when we're talking about preserving Prop 13, this does not benefit the parents at all, okay? It benefits the kids. And so you just have to be really careful. When, so I would encourage you, the Anonymous who asked all those questions, go ahead and set up a time to meet with us and we can go over those with you on an individual basis. And Anonymous asks, if I give my rentals to my children and continue managing and maintaining the properties, would my children have to pay me a salary and I'll have to pay income tax on it? Would I be covered by their liability insurance policies? That's something we can talk about one-on-one, but the idea here, you have to make a completed gift. What strings you hold on to is on an individual basis. Sometimes those strings will permit you to get an adjusted cost basis at death so that your kids can then start redepreciating the property, right? Some of those strings, you may not want that, right? If you have a larger estate, you may not want that. And then if the advantage, if it's what's called a grantor trust, if you take income out of that, or if you pay rent, it's, it's treated as your income, right? So if you were to pay rent to a grantor trust to live in the property, for example, you're not going to pay tax on that rent because you were the one who paid it and it's taxable to you. So there are a lot of, and I know I'm getting technical, but there are a lot of advantages on that, as opposed to just making an outright gift. So Lotna asks, Dad passed away. I want to retain the family home. My 4 siblings want cash. He had a trust, but it was never recorded. How do I do this? Lotna, here's the bottom line. The trust is going to have to get a loan to buy out the siblings. That's very difficult. That's a very difficult process to walk through. You cannot buy out your siblings. If you do, 3/4 of the property is going to get reassessed. You have to do it the right way. There is a right way. And I would encourage you to make an appointment and visit with us on that. That's something we do literally on a weekly, if not a daily basis. We help settle up, right? And then what the trust does is the trust goes out and gets a short-term loan. Very hard to find someone who's going to lend money to a trust. We have a few lenders who do that, but that's not an uncommon circumstance. So you'll want to get on that right away. So it looks like we have no more questions. Any closing thoughts? Well, we have one more. Does a trust need to be filed with a government agency? No, not the trust. Any closing thoughts, Chris?
Just keep an eye on what happens in Georgia. I think that depends. That's going to determine a lot of what happens in 2021 with taxes anyway. And do your planning for this year. And if you haven't done so already, try to get your advisor to do a projection for you so that at least you know where you are, so that come April, you're not getting hit with a surprise. And because I do think a lot of people are going to get hit that didn't do the planning this time of the year. But I would highly encourage everyone to do some of that this month and try to, because there's still a few things you can do to try to mitigate the bill. Even just knowing you got the bill is good enough in a lot of cases so that you can plan for it as you're running your business.
I can tell you on that revenue ruling where the PPP, I was surprised that the IRS came out and they didn't give flexibility, because that is a real, think about all the businesses who got a PP loan and used the money and they don't have any money left.
Right.
Right. Or a restaurant. What are they supposed to do? That's terrible.
Yeah. The next round, I think, is going to be, I keep thinking the next round of PPP funding, it's going to happen. The question is it's not going to be just blanket to everyone that is breathing and has got a business like they just did before. I think it's going to be real targeted to the people like the restaurants, travel, the salons, the places that have been told by the government they can't operate anymore because of all that's gone on around here. And so I think those are the travel, tourism, all that stuff. I think they're going to get another round. But if they don't start getting them opened up, it doesn't really matter. I talked to 2 people yesterday that are in the tourism business, and they're like, I don't even know if I'd take it if I got offered again, because that means I got to bring my people back and I don't have anything for them to do, because we're not open again, and because they've shut down some things. And so therefore it's like, I'm not sure that some people will take it. I think others will take it, and hopefully the salons will open back up, or I guess they're deciding whether they're closed or not, or a lot of them, I think they closed yesterday. I can't figure out whether that really happened or not, but I think that's what's going on.
Carol asks, is it better to will individual properties to individual kids? I think it depends on your situation. But if you have a portfolio of investment properties, it might be best. Well, here's what's going to happen in the post Prop 19 world. After February 16th of 2021, there is a mechanism. Basically, if you do it right, very little of your property should ever get reassessed, but it's a very expensive, very long process, and lawyers are involved and CPAs are involved. That's what very wealthy people do to avoid any reassessment or very small reassessment. So I would say individual properties to individual kids makes sense if you're talking about a house that a kid's going to live in, right? But if you're talking about, an office building, it might make sense, that's a business that's managed. It might make sense to bundle it with the kids. So, all right. Well, Chris, thanks for Thanks for joining us. Oh, to see this webinar again, do we go to Cunningham Legal website? You can go to our YouTube page. I would really, by the way, we've talked about a lot of stuff here that is on our YouTube page, right? Prop 19, we got 2 or 3 or 4 webinars on that. We've got webinars on 1031 exchanges. We've got a lot of different, our other tax webinar that we did with Chris is on our YouTube page. So I'd really encourage you to check out our YouTube page. And all right, I think that's a wrap. Chris?
Yeah, thanks for having me, Jim. Appreciate it.
Good to see you.
You guys have nice holidays. Thank you.
All right, bye-bye.